All right, everybody. Thank you guys all for being here today for the Quest Tuesday class. So it'll be our class for the week. We're going to be having Zack Ellison join us today, talking about venture debt. So he's got a really good presentation. We kind of discussed a little bit about his topic and what he's going to be talking to you guys about before. So I'm very excited to listen to it myself. We'll give it another minute or so. Wait for everybody else to get on here. Looks like people are still joining. But just to kind of go over a few housekeeping rules as we get started. Please post all of your questions down in the chat below. We'll be able to read them as we go through, and Zach will see them as well. So see, we'll give it just a little bit longer. Alrighty. Let's go ahead and kick it off. I'm sure we'll have some more people come on as we get going. But so for those of you that have just joined, my name is Colin Taylor. I'm on the ARI'S specialist team here at Quest Trust Company. And I know I mentioned it at the beginning, but we are having Zack Ellison on today to talk about venture debt. All right, guys. So let's kind of get into it. First thing that we always say when we start off these, presentations, webinars, whatever it is we're doing is, Quest Trust Company, and as an extension, myself and the ARI'S specialist team, we do not give any sort of tax, legal, or investment advice. So this class and everything else, that we do is really for, the purposes of your education to help you expand your knowledge, right? And kind of be able to learn and do this self-directed investing on your own, guys. So please bear that in mind as we go forward. Now, I want to explain a little bit about who is Quest. So we are actually one of the largest self-directed IRA custodians in Texas. We have about 20,000 active investor clients, not just in Texas, but across the country, right? So a lot of our client base is, here in the Texas, Houston area, but we also have a lot of clients outside of that. We've got about $2 billion in assets under administration. And then 100 employees with 34 that have that certified IRA services professional or CISP tag. And you have to go through a pretty extensive training course and take a tough test to actually get that certification. So that's pretty prestigious. And then the other thing is we have about $400 million in undirected cash, meaning our clients are looking to find ways to put their money to use, right? Find places to invest their money. So our clients are definitely looking for deals, and that's kind of what Zach is going to talk to you guys about. So if you like these types of videos, please follow us on Facebook, or follow us on YouTube, like us on Facebook, and you can definitely see more of these types of things that, through those avenues. Another thing is we continuously have these types of webinars and continue to put out education for you guys. We're pumping it out twice a week, every week. This being the first one, Tuesdays, 12 p.m. every week, as well as Saturday at 12 p.m. every week. So we have a different webinar, bring on a different speaker on Tuesdays and Saturdays at 12 p.m. every week. Additionally, we have our virtual networking happy hour, which is on the fourth Wednesday of every month. This month, it actually falls on tomorrow. So if you guys have not registered for that yet, please go and do so. It's going to be a great event. We'll have a lot of people from across the nation, that'll come out to do some networking and do probably some deal pitching and stuff like that. So that'll be a really good event as well. You can see any of the webinars or any of our recorded classes online, because we do record them. We post them on our YouTube channel afterwards. So go check that out, and you'll be able to see the recording of this as well if you want to refer back to it. One of our other big events coming up is QuestCon. This is going to be December 9th and 10th. So it's a 2-day event completely online. And what QuestCon is going to be doing is actually not only forecasting for 2023, but the first day we're going to be looking at 2022, doing a market recap, kind of analyzing what we saw, and then forecasting for 2023. We're going to be helping you guys give tips. We'll bring on speakers, experts. We'll have some panels. So that's going to be a really good one. I believe tickets are about $70. And if you want to buy the ticket with the recording, it's going to be $99.99. So you can buy tickets on our website. That's going to be December 9th and 10th. So last thing I want to mention to you guys is, because we always do have some new faces on with us, you can certainly reach out to us if you have any questions about anything that Zack talked about, anything that I mentioned here today. We're certainly happy to discuss or get you in contact with Zack, and I'm sure he'll share his information as well, and we'll try to put it out in the comments. But basically, you can call us at 855-FUN-IRAs. You can email me or any of the other IRA specialists at IRAspecialists@questtrust.com. We'll go ahead and put this info down in the comment section as well. And you can scan that QR code if you'd like to schedule a consultation. So let me see if we have any questions thus far. Let's see, Josh. Colin, if your clients are looking for deals, how would we reach out to them? So, we can't necessarily give out our client information, but I would say that networking happy hour would be a good one. And then as well, we have socials the first, second, and third week of every month. It'll be on Tuesday. We have the first one in Houston, second one in Austin, and then third one in Dallas. The third Tuesday is in Dallas. But we also put them online, so you can join those and pitch your deals there. That would be my recommendation, is doing something like that. But without further ado, let me go ahead and kick it off to Zack. I'm going to stop sharing my screen here. So yeah, Zack, welcome. We're excited to have you on, and I'll let you take it away.
All right. Thanks, Colin, for having me, and thanks to Quest Trust. I'm excited to be here because the product I'm going to talk about today, venture debt, is quickly becoming one of the most sought after products, mainly by registered investment advisors and their clients, because as you'll learn, it's a very good fit for high net worth individuals. So with that said, let's get started. A little bit about myself, just so you know kind of where I'm coming from. I spent the last 18 years or so in the fixed income markets at 3 different trillion-dollar managers. So I was at Scotiabank underwriting loans pre-credit crisis and through the credit crisis. Then I went back to business school at University of Chicago to get my MBA. And when I came out of Chicago, I went to Deutsche Bank to trade corporate bonds and credit default swaps at 60 Wall Street. Did that for a couple of years, and then went to a large insurance company that also owns many asset managers called Sun Life. And Sun Life manages about 1.4 trillion at this point. And spent 4 years there as director of U.S. public fixed income. A couple of years ago, I really had an epiphany, and I saw there was a huge opportunity in the market, and that market was in funding innovative VC-backed companies that were already generating a lot of revenue, and were looking for growth capital to get to that next step. And ultimately, debt is a very good option for these founders because it's cheaper and much less dilutive, of course, than equity. So venture debt the word venture doesn't imply risk. It actually implies less risk in this case, because the loans we're making are to companies that are already backed by the top venture capital firms in the world, who have put a lot of money and time and effort into funding these companies. So the other thing I should mention, just with my background, I've been a PM, I've been a trader, I've been a loan underwriter. I have my MBA from University of Chicago, which I mentioned previously. I also did an MS in risk management at NYU Stern, and earned the CFA and CAIA charters. And now I'm on the board of both CFA in Los Angeles and the CAIA in I guess it's called Southwest Chapter now. We just renamed it about 2 weeks ago. It used to be called the SoCal Chapter. So with that, I'm pretty experienced in fixed income. I've kind of seen the world from a lot of different perspectives and had success in all these seats. And I really do think that venture debt is where the world's headed. And we'll get into why throughout this presentation. So just a little bit about our fund, just so if people are interested, they can reach out. The fund is called A.R.I. Venture Debt Opportunities Fund. We're specifically focused on this venture debt strategy, which I'll explain. And we basically have two missions. Mission one is to bring very high risk-adjusted returns to our investors, while also providing them security of capital and a diversifier for their portfolio. Mission two is to provide access for underrepresented founders in the startup space. Historically, about 70% of the population, women and minorities, are getting 2% of the funding. And so there's a huge inequality here, but there's also a massive economic opportunity due to the inefficiency. It just doesn't make sense to have 70% of the population getting 2% of the funding. So we're actively looking to fund more underrepresented founders. We are set up as a 5-year closed-end fund, very similar to what you'd see with other private credit funds. We're 100% owned by our management company, Applied Real Intelligence. And the fee structure is 2 and 20, very standard. And we are able to custody assets at Schwab, Fidelity, Midland Trust, Millennium Trust, Quest Trust. And ultimately, if you would like to learn more about the strategy and potentially investing, it's best to just email IR, as in investor relations, at ARIVC.com. And then it's a very simple process. You basically email us at IR@ARIVC.com. We'll get you set up with our online portal, and all the docs are there, including the subscription docs. And it's a very seamless process that doesn't take very long at all. So with that, I want to just talk about what the big picture highlights are with venture debt. One is that the annual returns are typically about 20%. And because the loans we're making are floating rate, that return profile is actually going up in this increasing rate environment. So while everybody else is feeling the pain in fixed income, venture debt's actually doing better. The other thing that's noteworthy is the historical losses have been very low, and we'll dig into this later, less than about 0.25% per year. And that's due to the fact that these loans are senior secured loans with a first lien on all the company's assets. And the way we structure the deals at ARI really takes the risk profile down to roughly equivalent to investment grade bonds. So you're getting investment grade bond risk, but you're getting equity like returns. And last but not least, there's excellent diversification benefits because these loans have very low correlation to the broader markets and have what we term low beta to the market. So when the market is selling off, it doesn't really impact how our loans are doing. And ultimately, that's good for your portfolio diversification. So with that, today what we'll talk about is just an overview on the market's shift to alternative investments. Clearly, the public markets are getting hammered, and that's expected to continue. So a lot of investors are looking at what they call alternatives, meaning everything really outside of stocks and bonds. So that could be private credit, like venture debt. It could also be venture capital, private equity, real estate, structured products, commodities, etc. Then we'll talk about venture debt specifically, the benefits for founders and why there's such strong demand for this product. And then we'll talk about historical performance and attributes of venture debt, including historical losses and the risk profile, which everybody should be thinking about first and foremost. Then we'll talk about how ARI de-risks venture debt to really keep that risk profile as low as possible. And then we'll conclude with some Q&A from the audience. So I want to start out with just framing the macro environment. And I think most folks that are listening are probably acutely aware of how poor stocks and bonds have done year to date. So the charts we're looking at now were updated as of Friday, just a couple days ago. And what you can see is the S&P is down 21% year to date. Dow Jones is down 14%. NASDAQ's down 31%. And if you've been playing in the crypto space, that's been a disaster with Bitcoin down roughly 60%. What's more shocking to me, and I think shocking to a lot of investors, is how poorly investment grade bonds have done in the past year. And I shouldn't say this is shocking to me because I actually wrote a white paper about how this was coming, a year and a half ago. And essentially what you're seeing is interest rates rising, and because bonds go down in price as rates rise, you're seeing a big dip in bond valuations. And this is not really due to credit risk. It's really just due to what we call duration, or the interest rate sensitivity of fixed income securities. Looking at this table on the right-hand side, you can see that year to date, over, what is that, 9.5 months roughly, long-term investment grade bonds have lost 33% of their value. I mean, that's pretty shocking. If you're looking at your IRA and you're looking at your year-to-date results, and you're seeing your quote safe money in corporate bonds down 33%, with more losses likely as rates keep going up, you're probably not in a happy position, right? And this is part of the reason we're seeing massive demand right now from RIAs, high net worth individuals, et cetera, because they're looking at their statements and they're saying, why am I paying 1% a year to advisors that are putting me in products that have lost me roughly a third of my portfolio value in less than a year? So our house view, which I think is fairly consistent with many of the other top prognosticators, is that rates are going to keep going up. It's going to take quite a while to tame inflation. And the last three inflation prints in July, August, and September were all north of 8%. So you've got 8% inflation. And really, I don't know if the Fed's got a handle on it. So rates are, if anything, are going up in our view, which means fixed income is going down. So all that said, how do you make money in this environment? And a lot of people are looking at private credit, and specifically looking at venture debt, because we offer floating rate loans that benefit as rates go up. And we also have equity kickers on nearly every deal, meaning they're typically structured as warrants, which are the right to buy stock in the company in the future. And this adds upside that you wouldn't normally see in other fixed income investments. So I like this slide. This is welcome to the party, because most folks listening have probably never heard of venture debt, including most institutional investors. I've probably spoken to over 1,000 institutions in the last 2 years about venture debt, and 95% have no idea what it is or how it works, which is good for us because we're a market leader in the space and there's very little competition. But what we're starting to see, which we view as positive, is that some of the smartest institutional investors in the world are now entering venture debt, but not in a way that competes with us. So the first I would mention is Blackstone has announced that they're going to put $2 billion into backing tech startups on the debt side. And so some of these loans will be traditional venture debt. Many will be loans that are much larger than those that we would do. But it's nice to see that one of the best fund complexes on the planet now sees the merit in venture debt. For what it's worth, Blackstone's venture debt offering isn't available yet to investors, and probably won't be for a long time, as far as I know. So that it's mainly internal money right now that they're putting to work, from what I understand. KKR has also been mentioned in the news as trying to buy venture lenders and or build their own in-house venture lending team. And Oak Tree Capital, made famous by Howard Marks, who's one of my favorite investors, is one of the largest LPs in one of the 5 biggest venture debt funds out there. So basically, you've got Blackstone, KKR, and Oak Tree all in the space, but not accessible to money like yours. And that's where we come in. We run the strategy well. We have a lot of experience, and ultimately are looking to partner with RIAs and ARI'S as part of our fundraising process. So now let's hop into venture debt and exactly what it is and how it can fit in your portfolio. So big picture, venture debt it's a term loan. It's a very simple loan with equity warrants attached that we are making to tech-focused companies that are already backed by venture capital firms. Typically, these loans are short duration. They wind up being outstanding about 2 to 2.5 years. And they don't displace equity, but they complement it. So I'll give you an example that kind of frames it out. say a company wants to raise $50 million for their Series C capital raise. They're already doing at least $10 million per year in recurring revenue. And of that $50 million, of course, they'd like to utilize debt in conjunction with equity because the debt is a lot less dilutive for the founders. And ultimately, that's the key and why they like it. It's cheaper, it's less dilutive, and it can be ascertained faster than an equity raise. So what we'd see in this example is if a company wanted to raise 50 million, they would do 40 million in equity and then 10 million in debt. So we're coming in conjunction with, or typically after, the equity's been raised. And we're typically helping these companies by providing them with growth capital that will get them to the next milestone, whether it's the next big equity raise at a higher valuation, or being bought by a strategic investor, or going public, etc. So venture debt generally is used by companies for growth and expansion. It's pure growth capital. It's not for distressed companies. It's not for companies that, quote, need money. It's for companies that don't need it because they're low risk and they're able to then utilize debt because it's cheaper than equity. In other words, their success is what enables them to access the venture debt market. It's not for companies that are speculative, that are high risk, that are desperate for capital. That's not the fit. It's for companies that have already been very successful and have been funded by some of the best VCs on the planet. And we're coming in to just facilitate that growth and help them get to their milestones more quickly. In terms of comparable strategies or where this would fit in one's portfolio, it is a private credit strategy. It's really direct lower middle market loans. The difference between our loans and other loans in that bucket are that our loans are backed by VCs and they're also very tech heavy. So they're high growth. They tend to be very recession resistant, and that differentiates them from typical small businesses. Some of the benefits of venture debt relative to venture capital is that it's shorter duration. So when you're investing in VC, you're typically entering a fund that's locked up for 10 or 12 years, and you're probably not making any money for 7 to 10 years. And that's what's called the J curve effect, where you put in money and you're paying fees, but you don't get that payoff until the end. In our case, we're distributing cash distributions on a quarterly basis right from the outset. So when you invest, you step right into a cash flowing portfolio, but a portfolio that has the same types of companies that you'd see in the top VC portfolios. Also, so most of our loans are, like I said, 2 years. They're typically cash flowing about 15% annually, but that's increasing as rates go up. And we also get 10-year equity warrants on most of these deals with low strike prices, meaning we can buy the stock at a low price at any time over the next 10 years, typically. So all that said, in terms of the market, think of venture debt as sitting right at the intersection between direct middle market loans, which is roughly a $600 billion market each year in the US, and venture capital, which last year in 2021 was roughly a little bit over 330 billion. It's actually like 340, 345. So you've got both of these markets converging in venture debt, and it's a very unique subset of this broader market environment. Over the last 10 years or so, the venture debt market's grown about 6 times in size. So last year it was roughly 30 billion, or a little more than 30. A decade ago it was only 5 billion. So it's definitely growing at a very fast pace, and part of that's the growth of the venture equity market, but part of that is debt taking a bigger piece of the overall funding pie each year as well. So you've got 2 factors really influencing that growth. So we expect venture debt will probably be $100 billion per year market in the US within 5 years. So talking a little bit about when these loans come into play, I think is important. If you look at this graphic, you can see the typical startup timeline. And what you'll see is on the y-axis is cash flow, on the x-axis is time. And when you invest in a startup, early stage, you're losing money, right? You're helping them fund their growth, but they're not producing any revenue. We don't come in at that stage. We view that stage as risky and speculative and not suited for debt. We come in after the company's already generating significant revenue, and they're they're on a pace to triple or quadruple their revenue in short order. So we're coming in typically when the company's doing a minimum of 10 million per year in revenue, but oftentimes it's 20, 30, 40, 50 million a year. And we're helping them scale to many multiples of that in the next 2 to 3 years. So we look for the same things in our investments that equity investors would look for. Very strong management team with a track record of success, prior experience building and exiting companies. We look for a relevant product that's got competitive advantage, that's got traction already in the market where there's that product market fit. We're looking really for our highest conviction ideas where we believe in the industry, we believe in the company, we believe in the management team. And ultimately, most of these companies are tech companies of some sort or enabling some efficiency through technology. So we look at industries like enterprise software. Fintech is a specialty of ours because we've all worked at large banks and asset managers. Healthcare is a key vertical. Cybersecurity, clean energy, media and telecom, and supply chain and logistics, as well as sports-related investing. That's like a key market for us where we have a lot of experience and connectivity. So this is what the historical return from the debt portion of venture debt has been over the last 15 years. So what we're looking at here is the returns of 3 publicly traded business development companies known as BDCs, which specialize in venture debt, basically running a strategy very similar to ours in key regards. And the key takeaway here is that this information is public. These are all NASDAQ traded companies, and you can look up on their SEC filings and their annual reports all the loans that they've made each year, and you can see how they perform. And so what we know is if we look all the way back to 2005, the average yield has been very, very steady, like clockwork, like 15%, with almost no variation, very little variation. And there's never been a year in the history of venture debt when it's lost money, which we'll get to next. So what we're looking at here is just the debt return. It doesn't include the equity returns, which are a little bit harder to ascertain. But typically, we estimate that the equity returns are worth about 5% annually. So ultimately, you've got your 15% debt yield, which is being distributed each quarter. So on a net basis, you're getting 12, 13, 14% annualized in cash. And then you've got the equity upside as well. Now, if we turn to losses, this is my favorite slide because a lot of people think that venture debt must be risky. But when you actually have gone through the numbers like we have, you can see that it's actually anything but risky. So there's 2 huge lenders in the space. One is Silicon Valley Bank, publicly traded bank that many people have probably heard of. They're probably roughly 50% market share at this point. And the biggest non-bank lender is called Hercules Capital, and they're call them 15% market share roughly. So between these 2 companies, you've got 2/3 of the market, and we've got visibility into their historical losses. And what we can see looking at Silicon Valley Bank's annual write-offs is that their average write-offs each year in the last decade were about 29 basis points, so 0.3% roughly. And more importantly to me is how did they perform during the financial crisis? Because everybody performed well the last 10 years or so. If you didn't make money, you shouldn't be in the business, right? But now we're headed back to a much tougher environment. It's going to be much more akin to what we saw in 2008 through 2010. Therefore, we look very closely at how venture debt performed during that period. And what I think is striking is that in the worst year in history, in 2009, Silicon Valley Bank, which at that point was probably 2/3 of the market, only had to write off 2.6% of their loans, which means they still made money because the other 97.5% of their book was generating return and offsetting any of those write-offs. So the way I think about it is if you're worried about risk, this is a very good product to be in because it's never had a year ever in its history where there's been a drawdown and it's lost money. And even more striking than what Silicon Valley Bank achieved was what Hercules did over the last 16 or 17 years. They deployed to date roughly 14 billion in capital, and their loss rates were less than 5 basis points per year annualized. So they basically lost no money over the last 17 years. And what I take away from that is that if the two biggest lenders in the space have loss rates that low, the smaller lenders that are only lending to the best companies and not lending as broadly are going to have an even better chance of outperformance, meaning lower loss rates in this case. So just to highlight the key takeaways for venture debt from an investor's perspective, first thing to think about is superior risk-adjusted return. Historically, it produced 15 to 20%. In this market, that's gone up because we've seen base rates, meaning prime rate or SOFR, increase 3% in the last 6 months. And given these loans are all floating rate, their cash return has gone up commensurately. So, what was a loan that may have yielded 12% last year is now being priced at 15. If it priced at 15% last year, it's being priced at 18. And then because the market's getting a little bit more risky broadly, credit spreads are also increasing. So not only are you getting the pickup on the base rate, you're also going to get a little bit more credit spread on each of those loans as well. So net, we're seeing loans pricing 3 to 4% higher than they did a year ago, all in. What I like about the structure of venture debt is that those debt returns are contractual, meaning the company has to pay those to you legally. So you're getting your 15 to 20% on the debt side through this contractual payment and getting those distributions, but then you've got the equity upside that sometimes will be worth quite a bit if a company IPOs and is successful. Other thing to think about is the security of your capital, right? The reason loss rates are so low, and we'll get into this in detail later in this presentation, is because as the lender, most often you're going to be secured and senior and have a first lien on all the company's assets, meaning you're getting first bite at the apple. And if things go wrong, you're getting paid off first before the equity holders. Typically, these loans are very well collateralized with a loan to value of less than 15%, 1.5, which is gives you quite a cushion and enables companies to make mistakes without compromising the loan. Also, because they're supported by VC sponsors, the loans have a much lower risk profile than traditional loans to small and medium-sized businesses. In this market as well, if you look at the lower left-hand corner, we talk about additional benefits. And first and foremost, I think, is inflation hedging. Because they're floating rate, because you've got equity warrants giving you upside, they're the best inflation hedge you can get in fixed income. There's nothing else that I can think of that's better. And you're not suffering from that J-curve effect where you're losing money investing in PE or VC, hoping for a payoff down the road. And for folks that are interested in co-investing opportunities, that's something that we can do at ARI that the public funds can't do. In other words, if we were underwriting a loan that was $50 million, we might do part of that with the money from the fund and then open up part of that to our investors that could co-invest alongside us at reduced fee, so that investors can essentially cherry pick the exact deals they want to be a part of and put more money into that at lower fee. And last but not least, we talked about this before, but just the low correlation to the markets is a huge benefit from a portfolio construction perspective. Ultimately, the correlation of the markets is close to zero, certainly over a short-term basis, because the loans you're paying off every month, and what the market does in the interim doesn't really matter. So as long as the loans aren't compromised, you're going to get your payment, and the market volatility is just something you don't need to be concerned about. So one of the big things that's driving growth here is the demand for this capital from founders and from startups. And the reason that they're very keen to utilize venture debt is it minimizes their ownership dilution. Ultimately, if you're a founder and you've built a great company and you're on the verge of massive success, the last thing you want to do is sell more equity in that business. So you're much more inclined to borrow and keep a greater share of your equity ownership. Although we do take equity warrants in these deals, the dilution to owners is still much, much lower than it would be with a straight equity raise. So that's first and foremost what's most important to founders. It's also important to VCs, though, because a lot of VCs want us to come into the deals because it allows them to deploy less capital and preserve more dry powder to fund that company at a later date or to fund other companies in their portfolio. They don't always want more. Sometimes there's a set amount that they want to invest and they need to fill it out, and debt can help do that for them. So big picture, we've got the minimization of the dilution, but we also really focus on helping founders extend their runway and accelerate their growth, helping them get to that next milestone, helping them increase their valuations. And ultimately, debt is a lot cheaper than equity. It's probably about a third or half the cost of capital, and it's much faster to obtain. We can fund a company on the debt side in 4 to 6 weeks from start to finish. And to do that same transaction size on the equity side would typically take 6 to 12 months. Another thing that's really important to founders in this market is we don't need to have a fight with them over the valuation of their company, because if we're on the equity side, of course, we care exactly what that valuation is. And as an equity investor, you're going to be trying to push down that valuation so that your money gets you a bigger share of the pie. As a lender, we're not overly concerned about the specific valuation, and that helps us get deals done faster. It also makes us more aligned with founders, because while their equity investors are trying to push down their valuation, we want their valuation to be higher, right? So it's very nice for founders to be aligned with us in that regard. We also can put in very flexible structures, and ultimately our model here is to fund these companies through their full life cycle or close to it. So if we fund a company that's just done a Series B raise and they continue being very successful, we'd like to fund them at Series C and Series D and all the way until they go public or exit in some other fashion. So big picture, the way that these deals are structured really reduces the risk. The first thing we're looking at is the enterprise value of the company, meaning what's the company worth? And we don't take the valuation that the equity VCs put on it. We take that into consideration, of course, but ultimately we usually apply a very big haircut to that. So say there's a $200 million company that just did a Series B raise at the $200 million valuation. We do our own analysis and think this company's worth $100 million. Then we make them a $10 million loan. So essentially our loan to value in this case is $10 million loan, $100 million company valuation. So we've got a loan to value of 10%. And this is in line with what the better lenders in the space have done historically. What this means is that the company can destroy 80 to 90% of its value, and we're still 100% covered and unimpaired at the debt level. What we also look at, in addition to the company value, is the amount of cash that they've raised in their most recent equity round. Typically, what we're trying to do is be about 25% of the last round in terms of the cash. So if they've raised 40 million in equity, we would come in and do 10 million in debt. So essentially, we're now senior to all to everything, including this 40 million in cash that they've raised. And ultimately, that really helps us in terms of mitigating the risk, because you've got the enterprise value, but you've got this cash that's there to de-risk you as well. And then we look very closely at the liquidation value. In worst case scenario, if everything goes wrong, we get totally caught off guard in every which way, and the company screws up every decision they can we still sell this company for more than the amount of the loan? And typically we're looking for the liquidation value to be at least 2 times the amount of the loan, oftentimes multiples of that. So those are the big 3 in terms of asset coverage. It's enterprise value, cash that's on their balance sheet, and the recovery value in a liquidation scenario. And then we're looking very closely at their revenue profile. And typically we want most of these companies to be growing anywhere from 50% to a couple 100% annualized, and have a lot of recurring sticky revenue that's contractual. And thankfully, with a lot of the companies we're lending to, they're tech-based companies, and so they're actually signing up their customers for 1, 2, or 3 year contracts in many cases. And so you can actually get a very transparent look at what their future revenue is going to look like. In terms of sizing these, I kind of went through all this on the last slide, but I'll just kind of highlight this again. We're typically making loans that are targeted between 15 and 20 million, which is where the biggest opportunity is in the market. However, we'd make loans that are much smaller than that, and loans that could be much bigger. Our loans are all going to be North American based, and mostly in the US, but some in Canada potentially as well. When we size the loans, we're aiming to keep loan to enterprise value in the 10 to 15% range, no greater than 20%. The loan to cash, less than 33%, but in this market, typically 20 to 25%. And then the loan to recurring revenue, we typically want to keep less than 50%, meaning if the company is doing 20 million recurring revenue that's sticky, we would make them a $10 million loan. Most of the loans will be senior secured with a first lien on all the company's assets. This includes intellectual property. And all the deals have pretty tight covenant packages, typically with 2 covenants at least on each deal. The 2 most common covenants are a performance to plan covenant, which looks at revenue growth, essentially. And the other is a minimum liquidity covenant. All these loans are actually monthly pay. And so every month, we're not only getting an interest coupon that we pass through to our investors, we're also getting company financials and doing our covenant and compliance checks. We also will have board observer rights on the majority of these deals, meaning that we're observing all the board meetings. We won't be voting, but we'll know exactly what's going on with the company. And typically what happens is if things go wrong, the first call the company makes is to their board, and their second call is to us as the senior lender. So you're definitely getting visibility there that helps actively monitor and de-risk these deals throughout time. So not only do you de-risk them at the start with the structure, but you keep them de-risked by monitoring them. And if things start to go a little bit off, you'll catch it well in advance of anything material occurring. This is a slide I could send people offline. It just basically shows a stress test where we said, okay, what's the worst year in history, which is 2009. Let's double the losses from that year in 2025, assuming the market gets worse from here, which is our base case. Even in an environment where the losses were 2 times as bad as they were in 2009, you would still not lose money on a venture debt portfolio. And I'll show you why, and this will make intuitive sense to people. This is a slide that shows the cash flows that we get from a loan that we make, and it's on a monthly basis, right? So this graphic shows a loan that originally was a 4-year loan, very standard, 15% cash return. And the first 12 months are what's called interest only, meaning the borrower is paying us interest for those first 12 months. But in month 13, they not only start paying us interest, they start paying us principal as well, meaning the loan starts to amortize. And so each month after month 12, we're getting the interest payments plus the loan principal repaid. So what you can see here is ultimately you're getting a lot of your money back very quickly. And this is why the risk is very low. You're getting these interest payments, you're getting fees, like an upfront underwriting fee, also known as an origination fee. You're getting fees along the way. If a company prepays, there's typically a penalty associated with that. So you can get interest rate prepayment penalty fees. There's companies that sometimes need to amend their deal for various reasons, and you get paid for that. And there's also back-end fees, which are known as success fees, that we're paid as the lender whenever the loan is exited. So that back end lump sum payment is typically in this market about 5 to 10 points. So all that said, you're getting your money back pretty quickly though through the loan amortization and the interest payments. And so you can see here is if the loan were to start to go bad and 2.5 years into a 4-year loan, the loan defaults, you've already recouped about 85% of your principal. So if you made a $10 million loan, or if ARI made a $10 million loan, and we're making that loan knowing that this company's got about 3 years of runway, and then the company screws up a lot of things and they wind up actually defaulting 2.5 years in, well, we've already recovered, $8.5 million roughly on our $10 million loan. And remember, this would be to a company that at the outset was probably valued at 200 million, that we valued at 100. So the liquidation value of this company is still probably, significantly more than $10 million. It could be 10, 20, $30 million of liquidation value. And we only need to get paid back $1.5 million. Right? And that's ultimately why the loss rates are so low. It's very, very hard to lose money when you make a good loan at the outset that's got a bunch of cash, a great trajectory, very strong VC sponsors, and you're coming in to be the senior secured lender that will control the whole situation in an adverse scenario. This is just a quick slide on the returns and how you get to that 20%. And these are based on historical numbers. So these are not hypothetical. These are averages over time. So typically, historically, the cash interest was about 11%, but that was when rates were much lower. So now that cash interest has gone from 11% to roughly 14%. Success fees are the back-end fees that I mentioned previously. So typically, those back-end fees are a lump sum payment, but you divide that lump sum payment by the number of years that the loan is outstanding to get your annualized return from that. And then you've got other fees such as the origination fee, amendment fees, interest rate prepayment fees, etc. That gets you to your historical 15% debt yield, which is now in this market closer to 18%. And then you've got the equity warrants, which historically have been worth about 5%. We actually think the equity warrants in this market are going to be worth appreciably more than that for a couple of reasons. One is that company valuations have fallen quite a bit, as everybody knows, over the last year or so. So what that means is we're going to be getting equity warrants at a lower valuation, roughly half what the company was valued at a year ago. We're also able to take bigger equity stakes in this market because we have more negotiating power as lenders. And that's due to the fact that there's been 500 billion in companies funded in the last 2 years. And most of those are going to be coming to market to raise more capital from now through the next couple of years. And so you've got this massive demand for capital, but on the flip side, you've got a lot of capital providers stepping back because they're looking forward and seeing that there's this likelihood of recession. They're taking big losses. They probably made a lot of bad investments in 2020 and 21 at price levels that were wrong, right? In the sense that they're buying at market peaks, so there's nowhere to go but down. So there's a lot of existing capital providers that are stepping back out of the market. They're on pause right now. And that's converging with this massive demand for capital. So you've got the supply-demand imbalance, which makes it very, very attractive to be a lender in this market. There's roughly 3,500 deals done in venture debt each year in the US, and we need to do about 10 of them. And there's very little competition in the space. And that's why I love this market more than ever. In terms of why we think we'll outperform, I really want to keep this educational, so I won't go into this too much, but suffice it to say, a great product that's low risk, it's inflation hedged, it solves problems for founders, so there's significant demand. There's a lot, there's not a lot of competition, as I mentioned previously. And ultimately, we're providing a service to the borrowers. We're also providing a product that's very differentiated to limited partners. And so it's kind of like the perfect confluence of events for our strategy right now. other thing I'll say just about our fund is that we work with top tier service providers. We work with tier one in every bucket, whether it's fund administration, audit, banking, accounting, etc. It's all the best. And we don't have a legacy portfolio that we have to worry about because we're actually on fund one. And so we've got this amazing market opportunity without having to worry about all the mistakes that we could have made in 2020 and 21. And quite frankly, there were a lot of mistakes made because it's going to be some terrible vintage years, I think, in general for most assets. Because if you buy at the peak, there's just not a lot of upside. I mean, it's simple as that. Hold on for 1 second. Sorry about that. So in terms of our fund, I mentioned this earlier, but we're a closed-end fund, 5 years. We're going to roughly be about 150 million. We're doing our final close of capital in first quarter of next year. We're actually holding a close in November, another close in December, and we've got a number of deals that are fantastic deals that are in the pipeline that we're going to print probably before year end. It's 2 and 20 fee structure. We offer 6% preferred return, meaning we're not getting any of that back end carried interest until you've achieved at least 6% return. Typically, the minimum LP commitment was $1 million, but we actually have a feeder fund that enables investors to invest with a minimum of 100K. Every investor does have to be a qualified purchaser and not just an accredited investor, but it's very easy to invest. Essentially, all you need to do is email my team and we will get you all the docs, and they're all able to be processed online now. And then you can custody your assets at Fidelity or Schwab, Midland Trust, Quest Trust, Millennium Trust, wherever you like, really. So it's super simple. With that, let's do some Q&A. I see a couple questions. Somebody asked, is it fair to assume that this is a purely buy and hold investment with or without the warrants attached? The answer is yes. So this is not a liquid investment. If you invest, your money will be locked up for 5 years. However, you will be getting distributions of cash on a quarterly basis, roughly 12 to 15% per year net. And that's conservative in our view. Could be higher. And the equity warrants will be monetized during the lifetime of the fund, but typically those are monetized at the back end of the fund as these companies exit. Somebody asked, will you be sending out slides separately so we can read them? The best way to get the slides is to email us at ir@aribc.com. Then we can get you access to not only the slides, but the full data room and the subdocs. Just worth noting, I think most folks on this call will certainly miss the closing we're doing in November, but we are moving pretty quickly, and I don't anticipate we're going to keep this open for too long. So if folks are interested, it's best to start doing your due diligence now, because it's not going to be something that will be around for much longer. Just trying to see if there's any other questions we have today. Looks like somebody asked how to invest, and like I said before, just email us. We'll get you all the docs. It's all done online now. Very simple. So I think that's it. So thanks for joining. Thanks to Colin and Quest Trust for having me. I'm very excited for the growth that you guys are experiencing right now, and certainly the clientele that you service really is a good fit for what we're doing on our side.
Yeah, absolutely. Well, Zach, it was a pleasure having you guys. If you have any more questions, email Zach, email us. I did include the 2 emails, and I'll put his number down there in the comments as well. Is that your direct number, Zach, or is that for
I don't know. I don't really. Yeah, that's our that's our phone.
Okay.
Our company.
Yeah, that'll work. They can
I don't put my direct phone number on webinars. But.
Sure. I guess I just meant your work phone, but yeah, whatever works. So All right, guys. Well, yeah, if there's no more questions, we appreciate y'all coming out. Zach, thank you again. And we'll have this put up on our YouTube channel so you can watch the recording here shortly, probably sometime this afternoon or by tomorrow. So you guys can check it out there.
Thanks, Colin. And yeah, if anybody has any questions about investing, just shoot me an email and we can get you some information.
Yep. All right, guys. Thank you. Have a good one.
All right. Thanks.